Hello students, what's up? This is Professor Chintan Devalia on behalf of JK Shah Classes welcomes you to this RTP paper solving for May 2023. Subject is Financial Management Level CA Inter. I'm sure students you are cruising with the preparation of CA Intermediate and this paper solving will add some spice tarka on your preparation. Let me come to the point directly without you wasting your precious time. Two things. One, to make the best use of this session, I would say get your book, get your pen, get your paper ready and start solving the paper with me so that it will make a big time value addition on you. Number one. Number two, believe me students, this time the inter RTP of FM specifically is something a level above. Don't underestimate it. There are many points which are challenging, which are amazing and something rocking addition to your preparation. So let us start with RTP solving. Student, coming back to the first question. It's a ratio analysis. Amazing example. Amazing super duper question. One of its kind. See, from the following information, find out missing frequency and rewrite the balance sheet of Mukesh Enterprise. Current ratio is given, that is 2:1. Asset 3:2. Reserve surplus 20% of equity capital. Long-term debt 45% of net worth. Stock velocity 1.5 months. Mind it, it's a months, not times. Thereafter receivables turnover velocity 2 months. You may assume closing receivables as average. So obviously by default that assumption works. GP ratio 20%. Sales is given. Student, in ratio analysis, always get hold of a ready bit frequency and the sales is ready. And of that 25% are cash and 75% are credit. Closing stock, obviously, this is different from the opening stock. 40,000 more than opening stock. Accumulated depreciation, student, that means by default it will strike to your mind fixed asset is running at cost. Accumulated depreciation is 1/6 of original cost of fixed asset, meaning thereby whatever the value of fixed asset is, 1/6 is going to be your depreciation. Further, balance sheet of the company is given, student ready-made figures are given, and one request: never follow your format when the ICI has prescribed the format in the question. So blindly follow it. So whenever you start the solution, student, first thing is, I would say always prepare the format given in the example. The asset side, fixed asset, less accumulated debris, fixed asset, WDV outer column, stock, data, cash, which are your current asset, total, capital, reserve, long-term, BOD, and creditors. I think the format is ready. Clear everyone? Total we need to work out. Let us start with the solution, student. Question 1 is a ratio analysis. I am going to draw a same format with 5% liberty from our side so as to make the solution simple for you. This is, I would say, balance sheet as on 31st March. Thereafter, obviously I am not going to follow rigid all the format. Liability, amount rupees, assets, amount rupees. Student, one request. Students, I may be using some short form just to speed up the preparation, but I would say please follow full form wherever the extent it is possible for you. Asset side, I am going to write fixed asset less accumulated depreciation, and I would say balance outer column. Thereafter, it's a stock, data and cash, for which I will give a heading current asset, in which we will have a stock, we will have a datas, and we have a cash balance. I will take all these three balance outer column. On the liability side, it's equity capital, reserves and surplus. Long-term loans are given, that is 6,75,000. BOD and creditors are current liability. I do follow practice where we can write both of them inner column. BOD is 60,000 and creditor is missing frequency. Balance, I would take it outer column and place a total on both the side. Student, this is recommended that current asset, current liability, put it inner column so that certain missing frequency are easy to find out. Now, where to start with the example? Student, get hold of the ready-made figures. There are two ready-made figures available. One is a long-term date and second is a sales. You can start with any one, but I would love to get hold of long-term date. Reason on the top, check out. There is a ratio given. Point number 4, long-term date is 45% of net worth. So student, I can start with note number 1. Long-term date is 45% of net worth. We have a long-term date ready 675, which is 45% of net worth. So obviously my net worth will be ready. Can I calculate, students? That is 675 gives you 15 lakh. 15 lakh is a net worth. Yes, no? And we better know this net worth is divided between equity capital and reserve surplus. And the best part, the ratio of equity capital reserve surplus is given. Reserve surplus is 20% of equity capital. So that if I assume this is 100, this is going to be 20. So the ratio is 100 is to 20. So can I divide? Yes. This is going to be 12 lakh 50,000 and this is 250. And student, never shift to the next working mode unless you wind up posting this in your balance sheet, if it is possible. So student, equity capital is 1250 ready. Reserve surplus is 2,50,000 ready. Got it, everyone? Now, note 2. I can shift to the use of sales. Okay. Vice versa, you can also start with the sales. Does not make a difference. Sales is 21 lakh. So students, of that, check out. GP ratio is how much? GP ratio, they have given 20%. So I am sure you better know that remaining 80% is bound to be a COGS. So students, GP is going to be 4,20,000 and COGS is 16,80,000. Am I right? So with starting with long term, we computed net worth. Now sales is ready. We have a GP, we have a COGS. Now you have a choice. If you get hold of COGS, you can proceed with stock turnover. If you get hold of sales, you can proceed with what? Debtors ratio. But for debtors ratio, student, I need a credit sales. The choice is absolutely yours again. Note number 3. If we start with the debtors ratio, they have given me. This is going to be debtors upon credit sales into 12 equal to 2. The 2 months are given. I don't have a debtors, but I do have a credit sale, which is going to be 75% of 21 lakh. So that is 21 lakh into 75% is 15 lakh 75,000. Multiply by 12, this is 2. So students, I can easily calculate debtors. Can I? So that is 15 lakh 75,000. This gives you 2 lakh 62,500. Is it? Student, posting. Debtors, I can put it inner column 2 lakh 62,500. So debtors is ready. Now I can get hold of the COGS. Vice versa, you could have also started with stock turnover ratio, does not make a difference. Note number 4. Student, normally the stock turnover ratio formula what we follow is COGS upon average stock. But as the question works in terms of months, this question works in terms of times. So student, either you convert months into times, or let us just follow a formula of months, which is average stock upon COGS multiply by 12. Does not make a difference. Let us respect the question the way it is drafted. So it is 1.5 months. Average stock I don't have. COGS we are ready with it. It is 16,80,000. Multiply by 12, that gives you 1.5. So student, can I calculate average stock? Yes. So it's 16,80,000. This gives you 2,10,000. Student, now this 2,10,000 is average stock. Student, you might be wondering why not in times. You convert months into times. We better know 1 year is 12 months. So 12 months divided by 1.5 months, that gives you 8 times. Vice versa, you can solve it. There is no problem with it. Now, is average stock your opening stock? No. Is it your closing stock? No. It's the average of opening and closing both. And we have been given some information that closing stock is more than 40,000 than closing stock. I'm sorry. Closing stock is 40,000 more than opening stock. So student note number 5. I would say let opening stock equal to X. So closing stock will be X plus 40,000. Now, average stock is opening plus closing divided by 2, is it? Now, can I just open the bracket 2x plus 40,000 divided by 2 equal to 2,10,000? So, can I just compute x? So, x equal to 1,90,000. And what is x? This is opening stock. Therefore, I can say closing stock equal to 190 plus 40,000. So, your closing stock is going to be 2,30,000. And student, I am concerned with closing stock as far as balance sheet is concerned. So I can put closing stock 2,30,000 inner column. I think we're ready with this. What we did is we used data initially for the purpose of credit sales. Thereafter, we applied stock turnover ratio as COGS was available. So using that, we computed average stock. Now we have an opening closing segregation. Closing stock we computed, posted in a balance sheet. Now what next? Student, what are the ratios available? I think you better know current ratio and acid test ratio is there. Student, now can I apply current ratio? Note number 6. What is the formula of current ratio? CA upon CL. Now this is a place where student need to be little more cautious because we don't have either current asset, neither current liability. So what to do? Let us frame some equations. Mind well, this is an amazing point. We have a current asset upon current liability 2. Therefore, I can say current asset equal to 2CL. See? Now, obviously certain ratio works in a pair. Student, after current ratio, always have a practice of applying acid test ratio, which is CA minus stock upon CL, and the ratio given is 3:2. Yes, no? Now we don't have a CA, we don't have a CL, but we have a stock available, and I will substitute CA with a 2CL. So students, instead of current asset, I can write 2CL, closing stock is 2,30,000, CL is missing, this is 3/2, so I can easily calculate current liability now. Can I, student? Current liability, that is 3CL and 4CL minus 460. So yes, CL is going to be 4,60,000. And as CL is ready, student, current asset is going to be 2 times of 460, which is going to be 9,20,000. So student, now I can post current asset and current liability, that is 9,20,000 and that is 4,60,000. So student, I am sure there is some spark in your mind that balancing figure we can compute as creditor in current liability and cash and bank in your current asset. Can we compute? 460 minus 60 is, this is 4 lakh and this is 920 minus 2,30,000 minus 262,500, that gives you 4,27,500 is cash and bank or a cash balance. Student, I think one more spark in your mind, you can understand current liability. With the help of current liability, we can obviously now compute total of the liabilities. So 12,50,000 plus 2,50,000 plus 675 plus 4,60,000, it is 26,35,000. Same applies to this side, 2635. And balancing figure, student, I can easily compute fixed asset, which is WTV. Can I? Minus 9,20,000. So this is 17,15,000. Clear everyone? Perfect. Now understand student, we have fixed asset outer column ready, which is a WDV, and we better know that 1/6 is a depreciation. So can I say if the fixed asset at cost, whatever the figure is, 1/6 is accumulated depreciation. Students, if you understand, WDV fixed asset is 1715 and 1/5 is accumulated depreciation. So I can definitely say WDV is going to be 5/6. Or to keep it more simple, if this is 6, this is 1, this is going to be 5. I think more easy for you because 1/6 is depreciation. So if I assume 6 as fixed asset cost, 1/6 will be 1 rupee, will be your accumulated depreciation. The outer column will be 5. So I can vice versa apply 17,15,000 divided by 5. It is 3,43,000. What is 343? Accumulated depreciation. So I can easily calculate this. That is 20,58,000. Clear everyone? Okay. The student, even I can show a working note for the same. You can say that is note number 8. That fixed asset WDV is 5/6. Yes, no? Of fixed asset at cost. Student, this is how much? We have just computed, 1715. This is 17,15,000. 5/6 of fixed asset at cost. I can say fixed asset at cost. It has to be 20,58,000. Perfect, everyone. The choice is your presentation, absolutely your choice. So student, this was one amazing example of ratio. Super duper, I would say definitely a last minute revision bucket. Student, the best part was you have to work out net worth. Thereafter you have to work out average stock, stock turnover ratio given in terms of months, current ratio and liquid ratio, substitution of equation, and icing on a cake was fixed asset WDV concept. So student, I am sure this example made some value addition to your concept clarity. Let us shift to the second example. Question number 2. Cost of capital. Again, very good example. Student, believe me, this time RTP is amazing. Worth referring twice. Check out cost of capital. Amrit Corporation has the following. Amrit Corporation has following book value capital structure. Equity capital 5 crore 50 lakh of 10 each. Thereafter preference capital 50,000 of 100 each is 50 lakh. Retained earning 4 crore, 14% debenture of 100 each, that's 2 crore 50 lakh. Term loan is 4 crore. Students, you understand, we need KE, we need KP, we need KR, we need KD, we need KT. Company last year EPS was 5 last year, and it maintained a dividend payout of 60%, meaning thereby out of 5 they paid 3 rupees dividend and ROE is 40%. Student, this is amazing point. You should be clear that this is somewhere referring to the concept of growth rate. I'll come to the later point. The market price is 20.8 of equity. Preferential redeemable after 10 years, matlab redeemable preferential, currently selling at 90. Debenture redeemable after 6 years and currently selling for 75% debenture. The income tax rate is 40%. Point number A, calculate WACC using market value weights. Student, I am not concerned with book value weights. I am going to be concerned with the market value weights. Point B, determine MACC if it needs. Student, amazing. See WACC with reference to market value, all the 5 short sums. And now MACC, it needs 5 crore next year. Amount to be raised is 60% equity, 20% debt, 20% retained earning. Equity issue will fetch a net price of 14 and a cost of debt is going to be 13%. Up to 40 lakh, beyond 40 lakh, it will be 15%. Forget MSCC Part B. Let us target WSCC. Student, 5 short sum we need to target: KE, KR, KP, KD and KT. Let us start with KE as per the information given. Cost of equity share capital. Student, can I apply the formula? K is D1 upon PO into 100 plus G. Yes, no? Student, I need D1, but what they've given is E0. E0 is 5 and D0 they've given, it is going to be 60% of 5, which is 3 rupees. Student, market price is given. How much? Equity, I have a market price. Let me check out. That is 20.8. So I need a growth rate. Growth rate is not given, and student, the best part is you need to apply the concept of growth rate, that is retention ratio into ROE. Student, remember, retention ratio is given. How come it is there? Student, check out. The dividend payout is 60%. So logically, retention ratio is 40% and ROE is given how much? 10. So your growth rate is going to be 4%. Student, can I calculate now KE? Yes. KE is D1 upon PO. D1 will be 3 plus 4% upon market price, which is 20.8 into 100 plus the growth rate is 4%. If I just apply a mathematics, can I work out KE now? Yes. That is 3.12. This is 19%. Yes, no? And obviously certain things works in a pair. Cost of reserve has to be next. And as there is no flotation cost, student, I would say KR equal to K, and so as this is going to be 19%. So student, amazing point was this, the calculation of growth. This was a highlight of KE, that a student need to understand whenever retention ratio and ROE are given, it has to be a growth rate on the cards. So KE ready, KR ready. Let us work out thereafter cost of preference share capital. Yes, KP is PD plus RV minus market price given, divide by number of years, whole divide by RV plus market price upon 2 into 100. Can I have my frequencies ready? Yes. Face value of, always start with the face value, 100. Preference dividend is given, 15% of 100 is 15. Student, number of years, preference 10 years. RV when nothing is given 100, and student market price is given. Market price of preference is 90. So student, I can easily compute KP now. KP is PD plus RV minus market price upon number of years, whole divide by 100 plus 90 divide by 2 into 100. Can I just compute KP now? Yes. This is 10 divided by 10 plus 15 divided by 95 into 100. 15 plus 1. It is 16.84%. Perfect, everyone. Next is cost of debenture. KD I1 minus T plus RV minus market price upon number of years, whole divide by RV plus market price upon 2 into 100. Student, as usual, start with always a face value, 100. Interest rate is 14% of 100 is 14. Student, tax rate is 40%. Let me check out number of years. That is 6 years. Redeemable value, nothing is given, is 100. And market price, it is 75. Can I apply now KD? Yes. KD is 14 into 0.6 plus 100 minus 75 upon 6 whole divided by 100 plus 75 upon 2 into 100. Can I compute KD now, everyone? That is 100 minus 75 divided by 6 plus 8.4 divided by 87.5. It is 14.3637%. 36%. Yes, no? And last but not the least, by default we need to compute cost of term loan. Student, very exclusive example where all the 5 short sums are covered back to back. It is I1 minus T, and check out interest rate of term loan is 13%. So that is going to be 13 into bracket 0.6, which is 7.8%. So student, you can see we are ready with all the 5 exclusive short sum. But the highlight of this point was computation of this growth rate. Amazing point, student. Definitely a last minute revision. Now coming back to the main point, what they've asked you is number 1. We have to compute WACC as per market value approach. So what we are supposed to do is, we are supposed to convert all the 5 given book values into market values. Can we convert? Yes. Let us start with equity capital. Student, mind well, equity capital market value is always supposed to be a portion between equity capital and reserve surplus in the ratio of the respective market value. Have this practice. It will never create any problem in your exam. Have this practice. So that is the same thing. I'm going to do this. Equity capital. How many number of shares are there? It is something like 50 lakh. What is the market value given, student? Let me check out. Market value given is 20.8. So that gives you something like 50 lakh into 20.8. That gives you 10 crore 40 lakh. And student, this 10 crore 40 lakh will be divided between equity capital and reserves and surplus in the ratio of their book value, which is 5 crore and 4 crore. So student, this is in the ratio of 5:4. So divide by 9 into 5. That is something like 5 crore 77 lakh 778. And this is divided by 5 into 4. That is 4 crore 62 lakh 22,222. See, have this practice. Thereafter, next point is, I would say, term loan. Term loan does not carry any market value. So I would directly take term loan is something like 4 crore. This is 4 crore. Student, next one will, let me take debenture. How many number of debentures are there, student? It is 250. So I would say this is 2,50,000. Multiply with the market price of debenture. We have just taken 75. That is 1 crore 87 lakh 50,000. And last but not the least, let me take preference capital. How many preference shares are there? 50,000 into 90, which is obviously 45 lakh. Student, can I make a total? That is 10 crore 40 lakh plus 4 crore 1 crore 87 lakh 50,000 plus 45 lakh. It comes to 16 crore 72 lakh 50,000. With a base of 100, I can allocate the values and the cost ready here. KE and KR are 19%. Term loan we have calculated 7.8%. Debenture we have calculated 14.36% and preference we have calculated 16.84%. Can I just allocate the weights now? This is like 34.54. This is 27.64. This is 23.92. This is 11.21. This is 2.69. Perfect 100. Now if I just multiply and make a final answer, 34.54 into 15% m plus 27 into 64 into 19% m plus 23.2 into 7.8% m plus 11.21 into 14.36% m plus and 2.69 into 16.84% m plus, it is something like 15.74%. Student, that gives you WACC 15.74%. This is as per market value weights. Clear everyone? Amazing. All the 5 short sums, one stroke along with WACC working. Conversion of book value to market value. This was one part. Second part to follow is again very superb. What they've expected from you is computation of MACC. So again, very beautiful part. Reason, here you are going to respect a chapter capital structure also. Because what they've given you, student, let me come to the point. They've given you 5 crore is required. And equity, debt and retained earning are the 3 different sections. They will just make a capital structure for a moment. This is 5 crore. Divided between equity capital, which is 60%. Thereafter reserves, that is 20%. And debt, they are specified 20%. So student, just if I say this is going to be 3 lakh crore, 20% is going to be 1 crore. And again this is going to be 1 crore. And in this part, student, they have given you 2 different breakup. Just check out what they have given is 14% will be the cost. 13% will cost for 40 lakh. So there is 13% debenture, that is for 40 lakh. And for remaining 60 lakh, student, the rate of interest they have specified is 15%. And as it is before tax, we need to give the effect of tax. So again, I need the 4 classic short sums. Now student, KE will change. Why KE will change? Because there is something like issue price given. It will fetch 14 rupees. So I need to recompute KE again. So student, KE will be D1 upon PO into 100 plus G. So this D1 is given 3.12, it has to be the same one, upon 14. What has changed is issue price only, plus market price is, plus growth rate is 4%. So can I compute KE? 3.12 divided by 14 into 100 plus 4. That is 26.28%. And student, again KR, as there is no flotation cost, I am assuming it just to be 26.28%. Thereafter, I need a KD, and here student I can directly take a shortcut, I1 minus T. So student, I would say this is 13% debenture will be 13 into the tax rate is 40%, the 0.6, that gives you 7.8%. And same way, 15% debenture is 15 into bracket 0.6, which is gonna be 9%. So again, I am ready with all the 4 short sums. Student, now what they've expected from you is computation of MACC, marginal average cost of capital, for which we are absolutely ready with the things. I can just start with equity capital, which is 3 crore. Reserves, which is like 1 crore. Thereafter 13% debenture, I would say 40 lakh. 15% debenture, which is 60 lakh. I would say this total is like 5 CR for me. I can allocate the weight with a width of 100, which are very simple this time. This is 60, 20, thereafter 8 and 12. And my short sums are absolutely ready. Equity is 26.28%. This is 26.28%. This is 7.8%. This is 9%. Students, can I compute the final answer? Thereafter 8 into 7.8%. And thereafter 12 into 9%. It comes to 20. Just again, let me recheck it once. Into 7.8% and plus 12 into 9% and plus, that is 22.73%. Here everyone, this is again very classic, whereby we have respected a breakup of a capital structure, computed KE, KR, KD, and again the most important part was MSEC. Student, again I would say this has to be in the last minute revision bucket list. It covers so many exceptionally good points. In fact, it covers almost all nooks and corners of the chapter. Clear everyone? So this was all about second question, that is cost of capital. Clear everyone? Anji? Let us start with the third question. That is about capital structure and student. Amazing question. If you are looking forward for computation of indifference point, you cannot find any better question than this. Again, very classic, one-stop destination for computing indifference point. Check the last line. Check the last line. Determine indifference point under both the alternative. Student, amazing example. Let us work out. Current capital structure of XY is given. Current structure is given. We have equity capital. We have reserve surplus. We have bonds. We have preference. We have additional funds required. But student, check out the presentation. Equity capital 7 lakh of 20 each. Reserve 10 lakh. 9% debenture 3 crore. 11% preference capital 3 lakh of 50 each. See, mixed match form is given. Additional fund required is 5 crore. XYZ is planning for the following alternative. Proposal 1, raise funds 25% by equity, 70% debt, and that debt will carry an interest rate of 10%. PE will be 12 times. Proposed alternative 2, raise 50% equity and 50% debt, 50% preference, 12% will be the rate of dividend of preference. PE ratio is given. Any new equity capital will be issued at a face value of rupees 20 each. That means the issue price is absolutely ready with you. Any new preferential capital will be issued at a face value of 20, which is irrelevant as far as number of equity share is concerned. You are not concerned with the issue price of preferences. Tax rate 34%, determine indifference point. Student, again, capital structure framing is ultimate part of this example. Student, can I start with? Student, whenever there is something like big time capital structure is given, be clear. Try to figure out the capital structure. You need 5 crore. अब स्टूडेंट ये 5 करोड़ कहां से आने वाला है? There are two plans given, plan 1 and plan 2. Plan 1, they say equity capital 25%, that is 1 crore 25 lakh, and thereafter they have given 10% debentures, which is 3 crore 75 lakh. Student, they have specifically given equity share will be at 20 rupees. So 1 crore 25 lakh divided by 20 is 6 lakh 25,000. Second plan, equity capital 50%, which is going to be 2 crore 50 lakh. And issue price, they have specifically kept it constant, which is 20. So that into 2, that gives you something like 12 lakh 50,000 number of shares. And remaining, what they've asked you, I think that is 12% preference capital. Yes, the remaining is 12% preference capital, which is 2 crore 50 lakh. Student, two plans, plan 1 and plan 2. Now, there is something like present capital structure. Student, framing of the structure is very important in this chapter. Student, can I have a present capital structure? What they've given you is equity capital. 7 lakh shares at 20. that is 1 crore 40 lakh. Student, they have given you reserves, which is 10 lakh. They have given you 9% bonds, which is 3 crore. And they have given you 11% preference capital, that is 3 lakh shares. Asset number of shares of preference are not important, that is 1 crore 50 lakh. Just can I make a total? And 8 crore plus 3 plus 1.5, that gives you 6 crore. 6 crore is a present capital employed. So soon I can easily say one company has 6 crore already capital employed in the business, planning to raise extra 5 crore rupees. There are two plans, 1 and 2, and we are supposed to just compute indifference point of these two plans. Keeping in mind, present is going to remain constant. This is gonna remain constant. Now, can I have an IDP ready? What is the formula of IDP? X minus I, 1 minus T minus PD upon N, whereby I am going to apply plan 1 equal to plan 2, and obviously X is a balancing figure. Student, can I compute the interest? Interest will be present, which is going to remain constant. So 3 crore into 9%, that is 27 lakh, plus this is 3750 of this. It gives you 64 lakh 50,000 combined interest as far as plan 1 is concerned. Yes, no? 1 minus D, tax is 34%, is 0.66. And student, we have present bonds ready. That is 1 crore 50 lakh into 11% is 16 lakh 50,000. I would say minus 16 lakh 50,000. Divide by number of shares. Be clear, student. Number of share again need to be respected. 625 and 7 lakh is constant. That is 13 lakh 25,000. So this will be divided by 13 lakh 25,000. This is equation of plan 1. Plan 2, X minus. Come on, student. Interest. This will be constant, but there is no interest in plan number 2. So we are very safe on this. It is 9% of 3 crore is 27 lakh. 1 minus T, 0.66. But the big point is, this time dividend. 11% is 16 lakh 50,000 plus 2 crore 50 lakh into 12% plus 16 lakh 50,000. That gives you, I'm sorry, let me check out once. 22 crore 50 lakh into 12%, and that is 1 crore 50 lakh into 11%, 1650. So 11% of 1 crore 50 lakh is like 1 crore 50 lakh into 11% plus 3 crore, it gives you 46 lakh 50,000. Divide by number of shares again, student, be on your toes. This 7 lakh will remain constant, plus 1250 is going to be 19 lakh 50,000. That's it. Now ready to rock with the equation. I would say reduce this is 1.325, reduce this is 1.95. Now open the bracket, cross multiply. If I open the bracket, this is 0.66x minus 64 lakh 50,000 into 0.66. It is minus 42 lakh 57,000 minus 1650 as it is, divide by 1.325. This is 0.66x minus 27 lakh into 0.66, which is 17 lakh 82,000 minus 4650. Divide by 1.95. If I just merge them, 0.66x minus 4257 plus 1650, it is 59 lakh 7,000. Divide by 1.325. This is 0.66x minus 1782 plus 4650, that is 64 lakh 32,000. Divide by 1.95. Can I cross multiply now? Yes. This is gonna be 1.95 into 0.66 is 1.287x minus 59,07,000 into 1.95. It is 11518650. Same way, 1.325 into 0.66 is going to be 0.8745x minus 6432 into 1.325. It is 8522,400. Student, I am expecting you are keeping pace with my mathematical calculation. Now 1.287 minus 0.8745, that gives you 0.4125x, and same way this is 8522,400 minus 11518650, it is 2996250, and a final answer on the card, student, divide by 0.4125, it is something like 7263636.36 and so on. The decimal working not required, but still I'm just respecting the ICI solution. That's it. Clear, everyone? Are you getting this? Amazing IDP computation. Student, all the three questions, ratio, cost of capital, and habit structure, till now we have covered our best question as far as chapter is concerned. Clear, everyone? So let us start with question number 4 now. That is about leverage. Student, check out a very simple example. Compared to the previous stage, this is absolutely a cakewalk. The selected financial data for ABC for the current year 31st March as follows. Student, 3 companies are given, A, B and C. Let us concentrate on A. B and C, that can be taken care the way we are going to work on A. A, variable expense 60%, interest 1 lakh, DUL 4, DFL 3, income tax 30%. Very simple, prepare income statement of A, B and C companies. And not only that, even point B, comment on the financial position and structure of these companies. Let us keep it simple. Let me start with company A. If I just prepare income statement, this is question 4. It will be obviously into 3 categories, A, B and C. Income statement starts with sales minus variable cost, gives you contribution minus fixed cost, gives you earning before interest and tax minus interest, gives you earning before tax minus tax, gives you profit after tax. So this is a very simple normal income statement. Let me put ready-made figures in company A. What are the ready-made figures given? Check out. It is only interest, and that is 1 lakh rupees. Tax rate is given 30%, but we don't have any other figure. So student, we better know that as the interest is the only ready-made figure given, the hint we need to catch is degree of financial leverage, which is EBIT upon EBT, which can be taken as EBIT upon EBIT minus interest. Student, if you remember, this is a breakup concept, that EBIT upon EBIT minus interest is same. So student, I don't have a EBIT, but I have an interest ready, and that interest is 1 lakh. This is equal to 3. So by doing a cross multiplication, 3 EBIT minus 3 lakh equal to EBIT, that gives you 2 EBIT is 3 lakh, so EBIT is 150. Mathematics. So 150, this is 50, 30% is 15,000. So my profit in this case is 35,000. So student, we are ready with the second part of the part. Now obviously DUL. DUL is contribution upon EBIT. We don't have a contribution, but we have a EBIT 150 and DFL is 4. So can I have a contribution ready? Yes. contribution is gonna be 6 lakh. As this is 6 lakh, obviously fixed cost need to be 4,50,000. Clear everyone? I can just put a question mark here. And last but not the least, student, I think variable expense is given 60%. I can directly say if sales is 100, variable cost is kitna percent? 60%. So contribution is 40%. This 40 is 6 lakh. This 40 is 6 lakh. So can I have this ready? So 6 lakh divided by 40%, 15 lakh. The variable cost need to be 9 lakh. Clear everyone? Similarly, you can definitely solve company B and C. I'm not wasting time on that. B and C has replica of it. Nothing new. Yes? Student, the profits, obviously this is going to be 70,000 and 2,80,000. And your sales will be 30 lakh. And this is 4166,667. This will be the answer, obviously. Now this is very simple. But student, this is your first part. For the second part, they expected some comment on it. So I will obviously say always, for comment part, always compute DCL by default. Student, there are 3 companies A, B, C. I think you understand. DOL, DFL is given. DCL is ready. We can compute. DOL is like 4, 3, 3, 5, 2.5, 2.5. This is gonna be 12, 15, and 2.5 into 2.5 is, 2.5 into 2.5 is 6.25. So student, if I comment as far as overall risk is concerned, this is high risk, high leverage, this is low leverage, and this is moderate leverage. However, we can step forward with, as far as DOL is concerned, this is company with higher operating risk, and this is a company with higher financial risk, and this is a company which has balanced operating and financial both. But given a choice, as far as overall risk is concerned, B is a high levered, C is a low levered, and A is a moderately levered company. Now you can put this in your own language. There is no problem with it. Clear everyone? Confident? This is all about the comment of the example. Question number 4. Clear? Aye. Question number 5. So again, very classic question number 5. Student, it's all about capital budgeting. Can you imagine? It's all about capital budgeting. Check out the question, everyone. Check out the question. Check out the question. Dharma Limited is an existing profit-making company and is planning to introduce a new product with a projected life 8 years. Student, amazing part. Check out. The equipment cost is 240 lakh and additional equipment costing 26 lakh will be needed at the beginning of 3rd year. What is beginning of 3rd year? So I can say from 3rd year onwards. So 2nd year end is the present value factor. At the end of 8 years, the original equipment will have no resale value. We have resale value equivalent to cost of removal. Matlab, practically no scrap value available. But additional equipment would be sold for 2 lakh. So there is a scrap value inflow available for additional equipment. As far as original is concerned, whatever scrap value you are going to get it will be against set off against cost of removal. Working capital 25 lakh needed at the beginning of the year. Needless to mention, it will be realized at the end of expected life. 100% capacity is 4 lakh per units and production and sales volume are given. Year 1, 2, 3 to 5, 6 to 8. Selling price 100. PV ratio is 60% contribution. Fixed cost is 16 lakh. In addition to this, advertisement to be incurred every year is separately given. Addition to it, it is separately given. Check out. Year 1, 2, 3 to 5, 6 to 8. Tax rate is 50%. 12% is appropriate weighted average cost of capital. SLM method, advise the management about desirability of the project. Again, last minute revision. Let us work out the whole solution. Student, I practically have a practice of computing certain working notes like this. I go for note 1, that is initial investment. What does it mean? If suppose I am supposed to start with the project, what is the investment required? So I am going to work this question rupees in lakh. So student, what is today's investment? Cost of machinery is 240 lakh. And you remember there is a working capital which is 25. So my initial investment today is going to be 265 lakh. Clear? Student, additional equipment will not be considered here as it is to be purchased at the beginning of third year, which is end of second year. That will be taken care later on. Note number 2, that is computation of depreciation. Anyways, we are supposed to respect it at any stage of time. There are 2 machines. So original, it is 240 with a life of 8 years. The depreciation is going to be 30 lakh. But which 8 years? This is going to be 1 to 8. And there is something like additional, which is going to cost you how much? Let me check out. Additional is going to be 26 lakh. Yes, that is 26 lakh. 2 lakh is a scrap. Beginning of third is end of second. So third year depreciation will be computed. 3, 4, 5, 6, 7, 8. This 6 years. So depreciation is going to be 4. But which 6 years? This is 3 to 8. And note 3, I always compute. That is scrap value, which is at the end of 8th year. And for me, there will be 2 inflows of scrap value. One is fixed asset 2 lakh and working capital, which I always add to it in a form of release of working capital, which is by default 25. So last year it has to be inflow of 27 lakh. See, this is a benefit that everything is structured with us. Everything is structured with us. Investment, depreciation and scrap value. Student, note 4 will be the computation of my cash flows. Now this cash flows, they have given 4 different years. I think, let me check out. Year 1, 2, 3 to 5, 6 to 8. Yes, this is going to be year 1, year 2, year 3 to 5 and year 6 to 8. Student, I need to start with units. And units are specifically given. If you check out, 100% cap is 4 lakh. First year is 20%. So student, 20% is going to be 0.8. Thereafter it is 30%, which is going to be 1.2 lakh. Thereafter 75%, which is going to be 3 lakh. And thereafter it is again 50%, which is going to be 2 lakh. Student, I think we are ready with the shootout. I can directly start with the contribution. Why contribution? Because 100 rupees is a selling price. 60% is a contribution. So this is going to be 60. So this is going to be 60 into 0.8 is 48. This is 72. This is 180 and 62 is a 120. Minus, obviously the fixed cost given. Fixed costs are like 16 lakh every year. Minus, obviously advertisement. They specifically given 30, 15, 10, 4. 30, 15, 10 and 4. And last but not the least, depreciation, which you have already computed. Note number 2 is 30 for the first year, 30 for the second year, and third year onwards this is going to be 34. Now student, I can compute profit before tax. 48 minus 16 minus 30 minus 30, that gives you negative 28. Negative, there is a loss, student. second year is 11, third year 180 minus 16 minus 10 minus 34 is 120, and last 120 minus 16 minus 4 minus 34, which is 66. Now the question arises, what about the tax treatment? Student, we have learned in income tax set off and carry forward of losses. Student, first year there is a loss. This loss will be set off against second profits available with the company. Student, a similar kind of example appears in our ICA module, whereby it is specifically given that losses are to be carried forward for next 2 years. So, in a similar kind of example in our module, the losses are carried forward and set off in future. Here, no such information is available. So, by default, it has to be assumed that it is set off in the same year. So, student, 50%, I am going to get a benefit in the same year. So, this 14, I am going to pay tax same year, 5.5. I am going to pay tax same year, 60, and this is 33. And thereafter, this will be my PAT. So, my PAT will be negative 14, 5.5, 60 and 33. Student, first year I have claimed a tax benefit in a very first year itself. Now, adding back depreciation. Depreciation how much? That is 30, 30, 34, 34. PAT, that gives you cash flow. Can I? This is going to be, there is 16, 30 minus 14 is 16. This is 35.5. This is, just a minute, write properly, 35.5. This is 94 and this is 67. But the main part is, here we have purchased additional machine of how much? 26 lakh in second year. So that will proportionately reduce my cash inflows of second year. So 35.5 minus 26, that gives you 9.5. Very important. You just can't forget this additional machine, which is purchased in the beginning of third. Beginning of third is end of second. That is very important. End of second is end of second. End of third is end of third. But beginning of third is end of second. So student, I am ready with all my cash flows. Can I compute the final part of the chapter? NPV, which runs like year, cash flow. Discounting factor, the specifically given 12% present value. Let me have this cash flows ready. Year 1, 2, 3 to 5, 6 to 8. Year 1 is like 16. This is 9.5. This is 94. This is 67. And 8th year, there is a scrap value and release of capital is 27 lakh. Let me check on investment is 265. So just make a total of this. That will give me PVCI minus PVCO, which is 265. And final answer will be my NPV. Let me have my discounting factors ready. That is 1 divided by 1.12 is 0.893. Thereafter, it is 0.797. Thereafter, 3 and 5 is 1.915. 6 to 8 is 1.363. And 8 is 0.404. Can I multiply and derive my answer? That is 16 into 0.893 m plus 9.5 into 0.797 m plus 94 into 1.915 m plus 67 into 1.363 m plus and 27 into 0.404 m plus. That gives you something like 304.0985 minus 265, that is 39.0985. Student, as NPV is positive, check out the last line. Advise the management on desirability of the project. So we can write a sentence at the end of the example that as the NPV is positive, it is advisable for the management to get hold of the project. Clear everyone? I think very classic student, very important last minute revision bucket. Student, Question 1 was ratio, important. Second was cost of capital, equally important. Third was capital structure, equally important. Leverage was very normal. That you can avoid for the last one revision. But question 5, capital budgeting, again, very classic example. Clear everyone? Perfect. Good to go ahead. आइए question number 6. Student, question 6 is risk analysis. I repeat, question 6 is risk analysis. And again, very good question. Obviously, this is something different. Check out. Rami Limited is a manufacturer of mobile phones in India. Currently, the company is dependent on foreign suppliers for the import of the battery. It is considering an investment of 55 lakh in a new machine for manufacturing battery for mobile phones. The expected life of the machine is 5 years and no scrap. It is expected that 3 lakh unit will be produced and sold at a price of 20. Estimated variable cost and fixed cost at 12 rupees per unit and 6 lakh is per annum. Consider 14% of the cost of capital. Ignore taxation and depreciation. No tax, no depreciation. That is a good breathing time. Calculate expected NPV. That's it. Forget everything. Can we compute NPV? Yes. Student, now this is going to be jackpot for you. But in such question, presentation makes a difference. Year. Question works for how many years? 5 years. I need a cash flow. Student, just check out the units are 3 lakh. So student, I would say the presentation 3 lakh units. Bracket, selling price 20 minus. Let me check out variable cost is 12. So 6 rupees is a contribution into 3 lakh. That is 18 lakh. And fixed cost is 6 lakh. So that I can deduct as a 6 lakh is a fixed cost. So student, that gives me my cash flow. 3 lakh into 6, 18 lakh. Sorry, 3 lakh into 8, 24 lakh minus 6. My cash flows as of now are going to be 18 lakh. Discounting factor is 14%. Present value, can I compute discounting factor 14? Is it given in the example? No. So 1 divided by 1.14, 1, 2, 3, 4 and 5. This is 3.4331. That is 3.4331 into 18 lakh. That gives you 6179580 minus PVCO, which is your 55 lakh. Can I compute NPV now? Yes. My NPV is minus 55 lakh is 679,580. Simple. That is what they expected in the part 1. Yes, no? Yes. Now part 2. You are also required to calculate the sensitivity of the project. NPV 2. 10% decrease in project variables, sale price per unit and sales volume, and 10% increase in fixed cost. Student, 3 variables. Selling price, sales volume and 10% increase in fixed cost. So nothing to worry. That is point number 2, which is considered to be our sensitivity analysis. So let me target one by one. A, it's a selling price. When there's a selling price 10%, variability is downside. Can I just compute a revised NPV? Here, 1-5. Cash flow. Student, be clear. Units are same, but what has changed? Instead of 20, it is 10% decrease. It is going to be 18 minus 12 and fixed cost is constant. Are you getting the point, everyone? So student, can I have my revised answer? That is 6 is 18 minus 6. This is going to be 12 lakh this time. Obviously, discounting factor going to be the same, 14%. That is 3.4331. So 12 lakh into 3.4331. Your present value are ready. That is 4119720 minus PVCO. That is 55 lakh. Student, just imagine your new NPV is gonna be negative. That is minus 55 lakh. That is 13 lakh 80,280. Yes, no? But this is not the end of the road. Student, we need to justify what? We need to justify percentage of sensitivity. That is very important. Earlier it was 679,580. Now this is negative 1380280. So can I calculate the percentage of sensitivity? Yes. This is minus 679,580 divided by again 679,580. Student, imagine the percentage of sensitivity is 303.11%. Imagine, student, 10% change in selling price downside will decrease your NPV by what? 303.11%. That is sensitivity. Same way. Can I have a part B ready? It's a sales volume. So this time units will change, student. Again 10% downside. Can I? Here 1-5. We need to compute cash flows. Student, again, units will be 2,70,000. Yes, no. Why 270, student? Because there is a change of 10%. This is 20 minus 12 and fixed cost is going to be 6 lakh. Can I revise mathematics? So that is 270 into 8 minus 6 lakh. 15 lakh 60,000. 15 lakh 60,000. Discounting factors are 14%. Which is obviously 3.4331. Can I have a present value into 3.4331? It is 5355,636 minus PVCO is 55 lakh. Yes, it is negative. Can I have that NPV ready? Negative minus 55 lakh. Student, that will give you a negative 144,364. But student, this is not end of your journey. I need percentage of sensitivity. Can I? This is, earlier it was 679,580. Now this is 144,364 negative. So your fall will be something like this. Can I have a percentage of sensitivity now? Minus 679,580 divided by 679,580. Imagine 121.24%. Student, 121.24%. A big time sensitivity. Yes, relatively less than the selling price. But again, sensitivity is there. There is a big time sensitivity. And point C, they will ask you fixed cost, which is 10% upper side to be sensitive. Can I? Here, cash flow, discounting factor and present value. How many years? 5 years. We need to recompute this. This is going to be 3 lakh. This is going to be 20 minus 12. But fixed cost will be now 6,60,000. Can I compute the answer? So 3 lakh into 8, 24 lakh minus 6,60,000 is 17,40,000. To be multiplied with 3.4331. That gives you 5,973,594 minus PVCO is like 55 lakh. Thankfully this time, student, NPV is on a little better side. So that is minus 55 lakh. That is 473594. Student, again, this is not end of the journey. I'm putting like this, percentage of sensitivity. Yes, earlier that was 679580. Now this is positive 473595 minus 679580 into 100. Can I compute? Minus 679580 divided by 679580 That comes to 30.31%. Yes, no. See, that's the big point. Student, if they ask you which variable is most sensitive, the student obviously answers selling price. And which is the least sensitive, it's a fixed cost. Check out, they've asked you. You are required to just measure the sensitivity. So no need to put a note which is more sensitive or less sensitive. We are happy with what we have computed. Clear, everyone? That is question number 6 about sensitivity analysis. Clear, everyone? Good example. Question number 7. Yes, let us check out which chapter? Dividend decision and your favorite Modi Granny Miller approach. Let us check out again. Rambo Limited has 1 lakh equity shares outstanding for the year 2022. The current market price of the share is 100 rupees. Company is planning to pay dividend of 10 per share. Required rate of return is 15%. Based on approach, calculate the market price of the share when the recommended dividend is declared and not declared. Because considers whether dividend is declared or not declared, it does not make a difference to the valuation of the firm. How many new shares are to be issued by the company at the end of the year? On the assumption that net income of the year is 40 lakh and investment bought is 50 lakh when dividend is declared or not declared. Meaning that my first answer is, we need to compute the market price. Thereafter, number of shares to be issued in the market. And third, prove that market price of the company at the end of accounting year will remain same whether dividends are distributed or not distributed. Come on, student, it's very simple. Today's price is 100 rupees. Company is planning to give 10 rupees dividend and required return is 15%. To student, already I can say 100 into 1.15. Because on 100, you need a 15% return. It has to be 115. Is it 100? Yes. No, I'm sorry. Yes. 115. And for 10 rupees is a dividend. The market price, when dividend is declared, is going to be 105. Not declared, it is going to be 115. Can we directly put on the formula? Yes. Let us work out. First, price at year 1. Student, the formula which I follow is P1 equal to PO, 1 plus K minus D1. Even you can write, does not make a difference. That is, vice versa, you can write that P1 plus D1 upon 1 plus K is P0. It does not make a difference what formula you are following. Huh? It's okay. Dividend not declared and dividend declared. Student, first answer 100, 1.15 is KE, no dividend required. 100, 1.15, 10 rupees dividend required. So P1 is going to be 115 and here P1 is going to be 105. I think very clear, everyone. Very simple. That is first answer. Second, additional number of equity share to be issued. Student, my mathematics will be little different from the presentation. Dividend not declared and dividend is declared. Student, can I have my earnings ready? Let's check out earnings are how much. It is 40 lakh and investment plan is 50 lakh. So let me take earnings is 40 lakh. Yes, no? Student, if the dividend is declared and dividend need to be there. In the first case, dash. In the second case, how many number of shares are there? Let me check out number of shares are 1 lakh of 10 each. So that has to be 10 lakh. 1 lakh equity shares. 10 rupees is a dividend amount. So I will be paying that. So in this case, student, my retained earnings will be 40 lakh. And in this case, retained earning will be 30 lakh. Mind well, my investment target in the exam, I think it is 50 lakh. Yes. it is 50 lakh. It is 50 lakh. So I can say that remaining has to be raised by issue of equity capital. So in the first case, this is gonna be 10 lakh and this is 20 lakh. And this will be the pricing is P1, whereby this is 115 and this is 105. So I can calculate number of shares which was ultimately asked to you. So 10 lakh divided by 115, I can say this is approx 8696. And this is 20 lakh divided by 105, it is approx 19047. The number of shares what they've asked you is ready. And in third part, student, check out what they've asked you. Prove that the market value of the company at the end of the accounting year will remain the same, whether dividend is distributed or not distributed. So student, thereby you need to just calculate value of firm. And if you apply the formula, that is NPO equal to N plus delta N into P1 minus I plus E divided by 1 plus K. I think you remember this formula. Here I would say dividend not declared. Student, it is nothing but very simple. Dividend not declared. This is number of shares right now 1 lakh. Plus new shares is 10 lakh divided by 115 into 115 minus 50 lakh plus earnings are 40 lakh divided by 1.15. Can we? This is 10 lakh divided by 115 plus 1 lakh shares into 115 is the future price minus 50 lakh is the expansion plus 40 lakh is this. So it comes to this divided by 1.15. It is approx this 1 crore. Student, it was bound to be 1 crore because present number of shares are 1 lakh into 100 price. It has to be same. Same way, dividend declared, present share are 1 lakh plus this is like 20 lakh divided by 105 into 105 minus 50 lakh plus 40 lakh divided by 1.15. Can I? So this is 20 lakh divided by 105 plus 1 lakh into 105 is, I'm sorry, once again 20 lakh divided by 105 plus 1 lakh into 105 minus 50 lakh plus 40 lakh divided by 1.15. Yes, it has to be 1 crore. Which was bound to be 1 crore. That is 1 lakh share of 100 each. So student, obviously value of firm is not going to make any difference as far as whether the dividend is not declared or declared. This is the way you need to present it. Clear everyone? Perfect. That is all about question number 7. So let us come to question number 8 now. That is management of receivables. Again, definite last minute revision. Again and again, should I would say this RTP is amazing. Bearing 2-3 normal example, all questions are challenging. Last minute revision bucket. Question number 8. River Limited currently uses credit term 1.515 net 45, meaning thereby if the payment is done within 15 days, company will give you 1.5% discount, else you have to make a payment in 45 days. And the best part, ACP is given. How many days? 30 days. Company presently sales are 50 lakh. 30% customer takes discount. Defaulted is 5%. Variable cost is 65%. Student, amazing computation. Take your calculator. 50 lakh is the sales, of which 65% is variable cost, that comes to 32 lakh 50,000. And the total cost constitute what? 85%. So student, remaining 20%, it has to be fixed cost, if you understand. I hope you understand. 85% is total, 65% is variable. So 20% of 50 lakh, which has to be 10 lakh, is that is fixed cost. Okay. Company is planning to liberalize the credit terms to 1050. See, they are increasing a discount rate with the payment terms. 2% discount, 20 days as 50 days. It is expected that the sales are likely to increase by 5 lakh. Default chances are 10% as bad debts, and ACB will decline to 25 days. Next, there won't be any change in the fixed cost. By default, it is same, and 50% are expected to have a discount. Tax rate is given 35%. Evaluate this policy in comparison with current policy and recommend whether new policy should be implemented. Cost of capital 10%. 10% post tax is given. So no need to convert that rate from pre-tax to post-tax, is already post-tax given, and 1 year is assumed to be 360 days. So students, there are two policies. Let me start like this. Present and proposed. Present policy is 1.5 net 10 days upon, that is 45 days, and this is 2 by 1.5 upon 15, I am sorry, 1.5 upon 15, net 45, and this is something like 2 by 20 net 45, 2 by 20 net 50, sorry. It will start with expected profits. Can I have a sales ready student? Sales is 50 lakh, and here it is going to 55 lakh, it's given. Student, very crucial is variable cost, which they have given 65%. So 65% is 32 lakh 50,000. And next is 55 lakh into 65% is 35 lakh 75,000. Student, fixed cost at present level is 20% of 50 lakh, and which is gonna be constant 10 lakh for even a proposed policy. Student, this is very crucial. Minus bad debt. As of now, the bad debt is 5%, and future bad debt is gonna be 10%. So this is 5% is 2 lakh 50,000, and 10% is gonna be how much? Let me check out. Bad debt default charges will be 10%, that is 5 lakh 50,000. Am I? And further, minus discount allowed. As of now, out of 50 lakh, customer taking discount is 30%, that to 1.5%. And in future, it is 55 lakh, percentage taking discount is 50%, and that to 2%. Can I calculate discount allowed? 50 lakh into 30% into 1.5%, which is 22,500, and this is 55 lakh into 50% into 2% is 55,000. Can I make a total? 50 lakh minus 3250 minus 10 lakh minus 250 minus 22,500. It is 477,500 present profits, and this is 55 lakh minus 75,000 minus, that is 10 lakh minus 550 minus 55,000. That comes to 3,20,000. Student, this is the profit to be earned from the debtors on which we need to pay 35% due tax. Come on. So it is going to be 477,500 into 0.3, that is 30% is 167,125, and my profit thereafter will be, it is minus 310,325. In the next proposal, 320 into 35% is 112,000 minus gives you 320 into 65%, thereafter 2,08,000. Student, this will reduce to the extent of financing cost, which is cost of investment in data, which is always your working note 1, and thereafter you can derive your final answer as net benefits. Clear, everyone? Now, can I start with working note 1, which is cost of investment in data, or you can say carrying cost of data. Language does not make a difference. Answer is going to be same. At present, student, what is the ACP given? 30 days. And for propose, it is 25 days. ACP is 25 days. ACP is not Pradyuman. ACP is average collection period on a lighter note. I can have that ready. It is on variable and fixed both. That is 42,50,000 into 30 upon 360 into 10%. That comes to 4250 divided by 360 into 30 into 10% is 35417. So this is 35417. And for the second one, it is 4575 into 30, into 25 upon 360 into 10%. So the post-tax is given. There is 4575 into 25 divided by 360 into 10% is 31771. Can we compute the final answer? 310,325 minus 35417. It gives you 274,908. Is it? Yes. And this is 2,08,000 minus 31771. It is 176,229. Let me check out once. 310,325 minus 35417. It is 274,908. Student, which is a better option? Logically present. Within propose, even though the sales are increasing, overall net benefit is decreasing. So given a choice, we should put an advice that it is advisable for the company to continue with the present policy as it will give you higher net benefits. Clear? Very good example. Definitely last minute revision is there on the cards. Clear, everyone? Next, question number 9. So 9 is something very, very challenging. Very challenging. Believe me, beautiful, mathematically drafted question. Believe me, logic and mathematics at par. Check out. Kalyan Limited has provided the following information for the year 21-22. By working at 60% of the capacity, company is able to generate a sale of 72 lakh. Imagine the language, the way it is started. By working at 60% capacity, company is able to generate sales of 72 lakh. So if I take a calculator for a moment, 72 lakh divided by 60%. So my full capacity is going to be 1 crore 20 lakh. That is a full capacity provided I work on it. Next, direct labor cost is 20 per unit. Direct material cost is 40% of selling price. Now check out this. God knows what is selling price. And selling price, see the language. Selling price is 3 times the direct labor cost. Student, direct labor cost is 20 rupees. Direct labor cost is 20 rupees. So 20 into 3 times, selling price is going to be 60 and 1 crore 20 lakh is a full, divide by 60. So if I say my 100% capacity is 2 lakh units. Again, 60% is 72 lakh. So my full capacity is 1 crore 20 lakh. Selling price is 3 times of direct material, that is 60 rupees. So 1 crore 20 divided by 60, my full capacity is 2 lakh units. Profit margin is 25% on total cost. Imagine the way question has been drafted. Amazing. Now for the next year, 2023, company makes the following estimate. Production and sale will be 90% of the capacity. So when I say 90% of the capacity, what does it mean? It is 2 lakh into 90%. My future sales is going to be 1,80,000. Raw material price will remain unchanged. Direct expense per unit will increase by 50%. Direct labor per unit will increase by 10%. Despite the fluctuation cost structure, company want to maintain same profit margin on sales. So profit margin which was earlier 25% on cost, it will be the same. Further, raw material in store for 1 month, finished good in store for 2 months, production cycle WIP is 2 months, credit period allowed by supplier is 2 months, that is a creditor. Sales are made in 3 different areas, A zone, B zone, Z zone, that is C zone, and the percentage of selling price is 50%, 30%, 20% of the total sales, and a mode of credit for zone A it is 2 months, for zone B it is 3 months, and zone C, that is 20%, is absolutely cash sales which is not in our coverage. Forget it. There is no cash purchase and cash balance will be 1,11,000 directly given. Company plans for a working capital investment of the bank for the year 22-23. That is next year. Estimated net working capital of the company receivable to be taken on sales. Student, very unique. Normally investment in data in working capital chapter is always computed on cost. This is exceptionally they have given you on sales. You have to calculate data on sales, not on cost. I repeat, your data are computed on sales, specifically given. Also compute that is maximum permissible bank finance. That is a recommendation of Tandon Committee, 3 methods given. By using 3 criteria of Tandon Committee, assuming the stock of finished good to be a core current asset. Student, this is amazing question. The best part about the example is you need to be very clear how you are going to draft the question. So let's start like this. Just for a clarity, in the first line they have given, Kalyan Limited is working at 60% and generating a sale of 72 lakh. So student, I just can put a point, note 1, sales at 100% capacity. Just for a clarity, at 60%, that is 1 crore 20 lakh. So at 100%, I'm sorry, at 60% that is 72 lakh given. So at 100% it has to be 1 crore 20 lakh. In this, further, selling price per unit is 3 times of direct labor cost, which is 20. So 3 times of direct labor cost, that is 20. So selling price per unit is going to be 60. So I can say number of units at 100% capacity is just not required, but I'm just trying to make the points clear to you, is 1 crore 20 lakh divided by 60. So company can produce and sell 2 lakh units at 100% capacity. Clear? This is what the first paragraph has something to offer. Now I'm going towards note 2, which is obviously your cost structure and sales. Mind well. Student, I am gonna target present and propose both. At present, how many units are there? It is 1,20,000. How come 120? The capacity specified is 60%. So out of 100, there is 120. And for proposed level, company is gonna work at 90% capacity. So units will be 90% of 2 lakh, which is 1,80,000. So student, this is present and proposed both. Now I can say this is per unit information and this will be your total. This will be per unit information and this will be total. Looking to the structure it is given, we can write direct material plus direct labor plus direct expense is the only cost given, which is total cost. This will be increased with the profits and to derive your sales. Am I right? Now check out the information they have given. Direct labor is 20 rupees per unit. I can just put it directly. The direct labor is 20 rupees per unit. Selling price is 60. That is 3 times of this. And student, the best part, understand. What they have given you is direct material is 40% of selling price. So this is 40% of selling price, which is going to be 24. Now where is direct expense? For that the percentage of profits are given, 25% on cost. So student, just for information, if this is 100, this is 25. So this is 125. Done. This is one method. So 125 is 60. So 100 will be how much? Can I say this is going to be 48 and profit is 12. So student, this will be a balancing figure. And out of 48 is 44. The balancing figure is 4 rupees. This is one method. Second is, if you are directly clear with your concept, student, 25% on cost is 20% of selling price. Either way you can convert your answer. So 20% of 60 is going to be 12. Whatever method you are comfortable, you can proceed. Now units are ready. I can multiply 24 into 1,20,000. This is 28,80,000. 20 into 24, that is 20 into 1,20,000 is 24 lakh. And 4 is 480. It is 57,60,000. This is 72 lakh. Obviously available. The profits have to be 14,40,000. But to your utter surprise, we are not concerned with the present structure. We are concerned with the proposed structure. So in proposed structure, just check out what changes they have given. Production and sale, 90%, that is ready. Raw material price will remain unchanged. Yes, it is going to be 24 rupees unchanged. But that 24 will be multiplied with, I'm sorry, this is one extra zero added here. Yes, into 180, which is 43,20,000. Thereafter, a direct expense will increase by 50%. So 4 will increase by 50%, which is going to be 6. So 6 into 1,80,000, which is 10,80,000. And what about direct labor? Will increase by 10%. So this is going to be 22 rupees, student. 22 into 1,80,000. It's 39,60,000. So I can make a total of 4320 plus 10,80,000 is, I'm sorry, 43,20,000 plus 39,60,000. 39 plus 10,80,000 is 93,60,000, and total will be 52. Perfect. Now again, student, this is gonna be same. Let me put it like this. they are targeting same 25% margin. I think you understand this. So obviously this is gonna be 13 and this is gonna be 65. You can directly do it also, does not make a difference. So 9360 into 25%, that is 23,40,000 is profit targeted, plus 9360, and your future sales is 1 crore 17 lakh. Student, this was amazing part. If this is not targeted properly, it can get your question haywire. So student, we are ready with material, labor, direct expense, cost, profit and sales. Everything is ready. Now, ready for the working capital statement. That is what they've asked you, the first answer. So as usual, we can always say statement showing working capital requirement. And that is current asset. Student, I can compute one by one all the information given. Hardly 5 items are given, 3 stock, data and cash. And I have decided there is only creditor. So I can target one by one. What they have given you is stock. A, raw material. Student, stock of raw material will be computed. Practically, we are not concerned with this part now. Your target is for the next year. That is the proposed level. Be very clear. That is, stock will be computed on material. That is 43 lakh 20,000. Yes, no? I can compute 43 lakh 20,000 into 1 by 12. There is 3 lakh 60,000. B is finished good. Finished good is computed on cost. There is 93 lakh 60,000. And the terms are 1 month. Let me check out. For 2 months. I'm sorry, this is 2 months. 93 lakh 60,000 divided by 12 into 2. It is 15 lakh 60,000. And C, WIP. I can go for a note, or I can just show the bracket also. Does not make a difference. WIP will work on 150-50 completion. There is 4320, 3960 will be divided by 2, 1080 will be divided by 2. I can just show it. That is 43 lakh 20,000 plus 3960 divided by 2 is 19 lakh 80,000 plus 1080 divided by 2 is 5 lakh 40,000 into 2 by 12. So this is plus 540 plus 4320 divided by 6 is 11 lakh 40,000. If you want to prepare a separate note, it does not make any difference to the example. So the stock is ready. Now the second important point was datas. Datas, again, student, there are 2 zones, A and B. There is zone A. It is 1 crore 17 lakh multiply by, what is the percentage? 50%. 50%. And this carries a credit period, if not wrong, 2 months. So into 2 by 12. And B zone is 1 crore 17 lakh into the credit is 30% credit sales, and the credit terms are 3 months into 3 by 12. Can I do the mathematics? 1 crore 17 lakh into 50%. I can say this is 9 lakh 75,000. And this is 1 crore 17 lakh into 30%, and that gives you 8 lakh 77,500. Clear? Zone C is the cash sales. Forget it. No need to even specify. Cash balance are given 1 lakh 11,000. So all current assets are ready, student. I can make a total of this. This will be your A. 3 lakh 60,000 plus 15 lakh 60,000 plus 11 lakh 40,000 plus 9 lakh 75,000 plus 877 500 plus 1 lakh 11,000. It is gonna be 50 lakh 23,500. This format continues further. Current liability will be computed, and in current liability there is only one, which is the creditors. Student, creditors are computed on material. Yes, 43 lakh 20,000 into what is the credit period given for the creditors? It is approx 2 months. Credit supply is 2 months. 2 by 12. Student, believe me, this is gonna be a blunder, because creditors will be computed on purchase and 4320 is a consumption. So student, for that I need to specifically compute the purchase for this. But before that, let me just close the format for a moment. Working capital plus safety margin, which is given, it's fine, not given, we will ignore it. That will give you working capital requirement. Student, can I compute credit purchase, which is very highlight of the example. There is a computation of credit purchase. Student, apply the concept of material consumption. What is that? Opening stock of raw material. Student, that will be based on a previous 28 lakh 80,000. 2880 into credit period is 1 by month. So 2880, that gives you the opening stock of 2,40,000. See, this previous year there was a consumption of 2880. 1 month was the stock, closing stock kept by the company. Plus purchase of raw material, we don't know. Minus closing stock of raw material, we have already computed, student, this time. That is this 3,60,000. And consumption we better know, material consumption, that is 43,20,000. I think, student, there is a spark in your mind. If this point could not have in practice, it is very difficult for a routine student to get the strike in your exam that consumption need to be different from the purchase in this example. So 4320 plus 360, that gives you 46 lakh 80,000 minus opening stock is 240. So purchase is gonna be 44 lakh 40,000, and here creditors will be computed on 44 lakh 40,000. Very classic student, very amazing, 7 lakh 40,000. And yes, the total is again 740. Can I have the working capital ready? Minus 50 lakh 23,500. It is 42 lakh 83,500. No safety margin prescribed, 42 lakh 83,500. First answer, that is statement showing working capital requirement, particulars, amount rupees, and the table is absolutely ready. The big point was, two things to be noticed in this example was, one, data are on sales specifically given, and creditor need to be justified specifically by computing a purchase as a balancing figure. Clear, everyone? But still the question is on. This was first part. Check out second part in the question. Compute MPBF, that is maximum permissible bank finance, using 3 criteria of Tandon committee. Assume stock of finished good to be core current asset. Student, for MPBF, I need current assets, which is ready, 50 lakh 23,500. I need current liability, that is always excluding the existing bank borrowing, which is obviously not there, 740. And I need a core current asset. Core current asset specifically given. What is the core current asset given? Assuming stock of finished good to be core current asset. In this example, student, this will be core current asset, that is 15 lakh 60,000. The core current asset is 15 lakh 60,000. Just to clarify, this is stock of finished good. Good to go ahead now. There are three methods of, I would say, MPBF, maximum permissible bank finance. That is, we start with method 1. याद कीजिए स्टूडेंट, it is 75% of CA minus CL. I think you remember everyone. There is 75% of 50 lakh 23,500 minus 7 lakh 40,000. That is first method. Student, in method 2, if you remember, the only difference is the bracket, but obviously it makes a big difference to the mathematics. That is 75% of current asset exclusively minus CL. That is 75% of 50 lakh 23,500 minus 7 lakh 40,000. There is this. And thereafter method 3 is, if you remember student, it is 75% of current asset minus core current asset minus CL. So student, that is 75% of 50 lakh 23,500 minus 15 lakh 60,000 minus 7 lakh 40,000. Can I compute this? Yes. Let us have a final answer ready. 50 lakh 23,500. Sorry, 50 lakh 23,500 minus 7 lakh 40,000. That is 50 23,500 minus 7 lakh 40,000 into 75% is 321,625. 50 lakh 23,500 into 75% minus 7 lakh 40,000 is 302,765. And the last one, 50 23,500 minus 15 lakh 60,000 into 75% minus 7 lakh 40,000 is 185,765. So students, these are three methods which have been prescribed by Tandon Committee for computing maximum permissible bank finance. So again, this question of this, there is RTP, very classic. See student, this RTP is genuinely a level above. Agar if a routine student have not gone through this RTP once, it is very difficult to target such question in your exam directly. See, I don't underestimate your preparations, but I am obviously guiding you. These points are very, very different. Clear? That was all about question number 9. The student, come to the last part of the question. Yes? Theory student. Theory. Question number 8. Student, one warning. Please don't ignore theory in this paper. 10 marks theory can play a very, very vital role for your exemption, for your rank, for clearing the second group. Because at times, even one bad example of 10 marks in FM can be a disastrous if you have not referred the theory once. Please go through the theory once, very important student. You can't ignore theory. Because normal student have a tendency, we can leave theory option. No, it can get your attempt into option. Still you have a time, we are on a very good footage, you can refer the theories. Clear? Okay. Coming back to it, highlight the similarities and difference between samurai bond and bulldog bond. Student, very simple. It's just a simple similarities and difference. I would say it's a difference between samurai bond and bulldog bond. Student, very simple. Let me go like this. Keep it simple. Samurai, Japan, bulldog is London, Great Britain. So student, let us go like this. This is in terms of denomination. Who are issuer? What is the regulation? What is the purpose and the usage? Student, Just very simple. Get hold of every word. Denomination. So this is in terms of Japanese yen. This is in terms of, you can say, pound, or sterling, whatever. Second, issued in which country? So this is issued in Tokyo. This is issued in London. Who are the issuer? It's a non-Japanese companies, and this is non-UK company. Regulations will be governed by, obviously, Japan, and this will be governed by Great Britain. Purpose is nothing but to tap the Japanese market. It's a tap matlab access to Japanese market. And this is, we are planning to tap UK market. What is the usage? To fund our local Japanese operations, is to fund local UK operations. Very simple, student. See, this is a way you can make this theory very simple. Are you getting this? One is from Japan, second is from UK, and everything is ready. Clear? It's about tapping a foreign market. That is the reason, depending upon the local names, they have created this kind of names for the company. Coming back to the second option, what they ask you? Debt securitization. Student, debt securitization is nothing but recycling of fund. This is the recycling of fund. See, catch this word, recycling of fund. Recycling means you are converting your illiquid asset into liquid asset. For example, student, let me take an example of ICICI Bank. Just example. They funded crores and millions of rupees in a year for a home loan. Example. What ICICI will do is, ICICI will give a loan in a year. Second year, they need to again continue the same kind of home loan business. But they are running short of funds. So what they will do is, they will try to create a bundle of the security of home loan. They will sell it to a mediator. Those mediator are nothing but a special purpose vehicle. They will purchase the security from ICICI off balance sheet financing, and they will give the money to ICICI. But for that, SPV will target the public. See? So it's a ICICI giving loan to the public. ICICI going to SPV, SPV again going to the public, public going to ICICI, meaning public will again start approaching ICICI for getting home loan. And this recycling of funds will be on and on and on. ICICI giving loan to public, public giving funds to SPV, SPV giving funds to ICICI. This securitization process will go on and on and on. Are you getting this? Clear, everyone? So this is nothing but something about balance sheet, off balance sheet financing, which is nothing but recycling of funds. Special purpose vehicles are nothing but, they are the entities who are mediator between, I can say, bank or institution and a public. Clear, everyone? I just tried to sum up all this theory in a very simple, lucid form. I'm sure, student, this session was very fruitful for you. I've tried to cover each and every corner of the RTP. And I'm sure if you go through this rigidly, I'm sure many concepts which are untouched yet will be very clear, clarified. So student, this is Professor Chintan Devalia signing off with best wishes for your May 23 attempt. Just rock the exam, be confident, and come out with flying colors. Awaiting to welcome you at a red carpet at CA final. Thank you very much. Thank you. Bye-bye.